Okay, so chapter 10 was about contributions into a partnership. Chapter 11 is about distributions from a partnership. Okay, so, and we talked about inside and outside basis yesterday, so the other day. So just to recap, here's our partnership. And we have partner A and partner B. The inside basis is the basis of all the assets that are actually inside the partnership. So inside basis. So if the partnership owns any equipment, any vehicles, the inside basis means that the partnership owns those assets. Whenever we say outside basis, we're talking about the partner's basis in the partnership. So the partner's basis in the partnership. So remember, the outside basis could be the initial contribution plus the partner's share of income and loss items. And those items can be taxable or non-taxable. Minus any distributions, plus the increase to the partnership liabilities, only the partner's share. So if liabilities went up $10,000 at the partnership level, and we have a 50-50% partnership, then the increase for one partner would be $5,000. So just the partner's share. Minus the decrease to the partnership liabilities. Again, just the partner's share. We're going to have outside basis for each partner. Okay? All right. So, again, chapter 11 was about distributions from a partnership. We'll talk about proportionate distributions. So this can be liquidating, which means that either the partner's interest goes away in the partnership, or it could be that the whole partnership goes away, or else it's going to be non-liquidating just by default. Okay, so the first one we want to talk about is a non-liquidating proportionate distribution. Okay, so in this one we cannot have a gain. There will be no gain unless the partner receives a distribution in excess of his or her outside basis. Okay. Now, in this case, if the partner receives property, then that property is going to be stepped down. Okay, so assuming that the partner's outside basis is $50,000, and they receive property from the partnership in a distribution that has a basis of $60,000, then what's going to happen is the partner is not going to show that they have a gain. They're just going to show that they have a basis in that property of $50,000 now. Okay, so they're going to step down the basis of the property that they received. Okay, and then for this one, it's going to be no loss. Generally, no loss. Okay, we won't get into all the specifics. That's beyond the scope of this course. All right, then we can have a liquidating proportionate distribution. Okay, so the partnership is liquidated, or the partner's outside basis goes away, so they've been liquidated from the partnership, and the partner is no longer part of the partnership, in other words. So gain will be recognized only if cash distributions exceed the outside basis. The outside basis, which means the partner's basis in the partnership. Okay, the partnership basis, partnership interest basis. Okay, and then a loss recognized only when the partner receives cash, unrealized receivables, or inventory. So the next thing we want to talk about are the ordering rules. Okay, so we have ordering rules. We have ordering rules because a distribution can include a number of different assets. It can include cash, it can include inventory, it can include property, land. It can be more than just cash. So we have to recognize, we have to take into account the distribution based on what kind of asset it is. So the first thing is, the first part of the ordering rule, number 1, is going to be any cash that is distributed. And inventory. And then the third is going to be all other assets. So this is going to help us to determine whether we have a gain or a loss whenever we have a distribution that's made in a liquidating or non-liquidating proportionate distribution. Okay, so what I want to do now is kind of go through some of the questions in the back of Chapter 11. The first one I want to talk about is number 10. And this one is where Franco, he has an interest in Dulera LLC. They're making a distribution, so you can go ahead and read what the question is saying on chapter 11, number 10, at the end of chapter 11. Okay, so he's going to receive a distribution of, let's see, his basis is $128,000. The fair market value of the interest is $140,000. The LLC is going to distribute to him $30,000 in cash and equipment with an adjusted basis of $5,000 and a fair market value of $8,000 to him on that date. Okay, so we basically normally have to look at the tax basis and not the fair market value. So we're looking at the tax basis. So his basis right now in the partnership is $128,000. Okay, so it is a non-liquidating distribution, meaning that at the end of the distribution, he's still going to have some ownership interest in the partnership. So his basis is $128,000. They're going to distribute $30,000 in cash, $30,000 in cash. They're also going to distribute equipment of $5,000. Remember, we're going to subtract distributions from the outside basis. So if we subtract these amounts, the basis after his basis after the distribution is $93,000. Okay. It also asks, what is the amount of his basis in the equipment received? Again, it's going to be $5,000. His basis in the equipment is now $5,000. Okay, because we have a carryover basis. All right, now let's look at number 14. This is Magdalena. All right, Magdalena has an outside basis of $58,000. She receives a liquidating distribution, so not a non-liquidating. This one is a liquidating distribution of $15,000 cash and a proportionate share of inventory having a partnership basis, which means the inside basis of $20,000 and a fair market value of $24,000. The distribution results in a liquidation of both the partnership and her interest. Okay, so for this one, we're going to go back up to our liquidating proportionate distribution. This is what we're looking at for number 14. Okay, so look at what it says that when we can recognize gain and losses here. So let's see if any of these apply. All right, so her basis, Magdalena's basis, is $58,000. She receives a distribution, again, of $15,000 in cash. Oops, sorry. She receives inventory with a basis of $20,000. So at the end of this, we get to 23, right? So this would tell us that her outside basis after the distribution, right? So this would tell us that her outside basis after the distribution is $23,000, which we know cannot be true. Why? Because the partnership no longer exists. So instead of having a $23,000 basis in the partnership, now she's going to recognize a loss of $23,000. Okay? And this is because the partnership no longer exists after the distribution. Therefore, she couldn't have this remaining $23,000 of outside basis. Okay?